Hey there, Ken Zorvich, NFM Lending. Hope you're having an excellent start to your weekend. So, a lot of interesting economic news from this week, and a lot of it that has to do with interest rates. So, let's talk about what took place and what could we can maybe take away from it to figure out where interest rates could be going in the coming months here. So, first of all, let's recap a little bit. We had federal chairman Jerome Powell meet with President Trump. Now, what you need to understand about this dynamic is Trump actually hired Powell under his last administration. Now, they have a certain tenure. He can't be fired really till next May. So Powell's in place from now until then. Generally, the rule of thumb is the federal or the Fed chair of the Federal Reserve does not really like they say they don't adhere to political pressure. Conspiracy theorists would disagree and they would say you could point to different times when interest rates came down that would help for political purposes, but they really don't. They really stay above it. So the big cog in all of this is Trump, as well as other people within the administration, and in fairness to Trump and his administration, even some economists think that Powell is keeping interest rates too high for too long. The Fed has said before that they want to see a soft landing. Now, if you think about what is a soft landing, so think about maybe like an airplane. If an airplane is coming down to land, does it you know, accelerate? Does it give the plane any gas to try and get the engines going? No, it pulls back on everything, right? It pulls back as much as it can and wants it to just kind of land softly, right? Now, the argument for dropping interest rates right now is the economy is sort of like a cruise ship in the water in that it can't stop on a dime and change course. It takes a minute for it to stop, right? So there's a lot of lagging data you've got to be mindful of. And it's why when you're talking about looking at economic factors, you have to almost read the tea leaves and say, okay, we can't stop immediately and change course if we want to. We know that the data that's coming to us right now may not be accurate in real time. And so we need to be mindful of that. So the argument for Powell to drop interest rates right now is because there's data out there that's pointing to some pain coming to the economy. The GDP came in low, unemployment starting to rise, inflation going down. Okay. Now, Powell doesn't want to lower interest rates because he wants to see what is the outcome of tariffs relative to inflation. Once again, no one really knows if this tariff situation is going to cause inflation, but Powell knows he can only lower interest rates to try and help the economy when it needs it. If he's restrictive for too long, then he's going to wait too long. The economy is going to hit hard and you're going to feel some pain, and then they're going to look to lower interest rates. So, is a soft landing that you would lower interest rates before they would technically need to be, and instead of being reactionary, being something a little bit more proactive? Absolutely. But they also don't want to succumb to political pressure, and he doesn't want to lower it thinking that Trump twisted his arm in order to do it. So this is the interesting dynamic. And they had a meeting this week. Little pieces of information are coming out about that meeting. I don't think we'll ever know, but I'm sure Trump told them to lower interest rates. And he said, thanks, but no thanks. So what does this mean now moving forward? Well, we need to keep an eye on some of the economic data that's coming out, like GDP, like obviously jobs, and see what's going to then take place with things like the bond market. Now, you see that people are saying the bond market's not that attractive now because of our growing debt. Well, the reason why I don't really buy that is our debt's been growing for years and I don't want it to grow anymore. But that can't be the reason that people are uneasy about buying US bonds. I think what the problem is right now is we're getting into a cash crunch. So everyone is issuing bonds, companies are issuing bonds, countries are issuing bonds. They're getting into cash crunch, and that's what you do when you need cash. You can issue bonds. So there are so many places where people could buy bonds, and investors are only going to buy so much. So if the bond market is flooded, the rates are going to rise. Or I'm sorry, the yields on the bonds are going to rise, and that's going to hit interest rates. So this is what we need to be mindful of. And in a weird way, you could say lowering interest rates could help out the bond market. It could help out mortgage rates. It could help out inflation so that there's not so much restriction on some of the goods that are being sold and everything. So keep an eye on this. But as far as mortgage rates go, I would expect we're going to start to see some glimmer of hope maybe in the next couple months. Fannie Mae just came out with another prediction for the year, which they usually do halfway through, and they still think by the end of the year we could drop by about 1% and get down into the low sixes. So listen, if you want to talk any more about this or discuss it any further, please feel free to reach out. Make sure you get in some time with some friends and family this weekend. As always, I'd love to be in this business in 5 years. If you know someone looking to purchase or refinance, please think of me. Have a great weekend.